Hello friends, today we are discussing about CAPM, that is Capital Asset Pricing Model, and my name is Parthik Bhimani. It is developed by the Professor Sharp and McConville in 1960, and Professor Sharp won the Nobel Prize in 1990s. The types of investor: risk taker, the investor who takes the risk; the averser, the investor who avoids the risk, and if he takes the risk, he asks for more reward, and in the case it is the risk premium. It is the model in which describes the relations between the risk and the expected returns. In this model, the security expected returns is equal to the risk-free rate and risk premium based on the strategic risk of the security. Mathematically, CAPM writes as RI equals to RF plus BI in bracket RM minus RF, where the RI required rate of returns of the security, RF equals to risk-free rate of the short-term government bonds, BI equals to it is the systematic risk of the security J, which cannot be diversified. RM equals to required rate of returns of the market. RM minus RF equals to risk premium because of bearing risk. B is beta. Assumptions of the CAPM. The capital market is efficient in that investors are well informed. No transaction cost. Negligible restriction on the investment. No investment is large enough to affect the market price of the stock. There is no tax. The quantities of all the assets are given fixed. All assets are perfectly divisible and perfectly liquid. Investment opportunities. The investment in the risk-free securities whose returns are fixed. Short-term rate is used as a CAPM. The market portfolio of common stocks. Beta is it tendency of the stocks to move with the market or portfolio of the all stocks in the stock market. It is building block of CAPM. Total risk is equal to diversifiable risk plus market risk. Total stock returns equals to dividend yield plus capital gain yield. Stock risk versus stock beta. Stock risk, it is a statistical spread of possible returns or volatility for the stock beta, it is a significant spread of a possible risk or volatility for the stocks relative to the market spread, that is spread of the fully diversified market portfolio or index. Beta coefficient of individual stocks are possible in a beta book by a stock brokerage and trading. Meaning of beta: for share ABC in a Karachi Stock Exchange. If a shares A beta equals to plus 2, then the share is twice as risky as KSC market. That is, if the KSC index moves up 10% in a year, then based on the historical data, the price of the shares B would move to 20% in a year. If the shares B is 10%, that is shares exactly as risky as K's market. If the shares 0.5, then the shares is only a half risky as the K's market. If you could find the shares D with the beta -1, then that shares would be exactly a volatile as a K's market, but the opposite way. That is, if the KSE 100 index moves up 10%, then price of the shares D would move down by 10%. The beta of the stock range between 0.5 plus and plus 1.5. The average beta of all stocks equals to beta of market equals to 1 always. Thank you.